You know, usually when you crack open an industrial giant's earnings report, you kind of expect the math to be relatively linear.
Right, yeah. Like if they ship more products, they make more money.
Exactly. You assume they're physically moving more goods out the factory doors, so the cash pile goes up. But then you look at Emerson Electric's first quarter 2026 tape, and you see their underlying sales crept up by like exactly 2%.
Which basically just matches historical inflation.
Right. So on paper, the physical volume of goods they moved was practically flat, maybe even down a little. Yet their profitability metrics just completely decoupled from that reality. I mean, they blew past all street estimates.
Yeah, it is. It's kind of the defining margin expansion paradox of the modern industrial sector right now.
It really is.
We're looking at a quarter where Emerson's management team, led by CEO Lal Karsanbhai, they basically manufactured profitability out of thin air.
How so?
Well, by ruthlessly executing on two specific variables: pricing power and operational synergy. They really didn't need a massive wave of new volume to print cash.
And that is exactly why we are here today. Welcome to the Special Talk Ticker Style Deep Dive. For those of you listening, our mission today is simple. We respect your time. We are keeping this tight, data forward, and zeroing in on the 3 to 4 most critical takeaways you need to know about Emerson Electric ticker symbol EMR right now.
Yeah, we're going to extract the core data and, translate all that dense corporate accounting jargon.
Because we want to figure out if this company's pivot into industrial software actually makes it a foundational holding for your portfolio. So let's put the baseline scorecard on the table.
Let's do it.
Adjusted earnings per share came in at $1.46. That's a 6% increase year over year, which beat expectations. Free cash flow was $602 million, boasting a really healthy 14% margin.
It was slightly better than expected, yeah.
And their adjusted segment EBITDA margin hit 27.7%. And before we go further, let's just lock down that term for anyone new to analyzing industrial tape. EBITDA.
Right. Earnings before interest, taxes, depreciation, and amortization.
Exactly. It's the purest look at a company's operational profitability. It just strips out all the noise of capital structure, debt payments, and the tax environment.
And seeing a 27.7% EBITDA margin against a mere 2% sales growth, that is where the core thesis for Emerson really begins.
Okay, let's unpack this. Because how does that actually work? How can sales only be up 2%, but earnings and margins beat expectations so soundly?
So on the call, management explicitly stated that favorable price-to-cost ratios were a massive driver. Like, pricing alone added 3 full points to their growth.
Wow.
Yeah. This tells us that the actual volume, like the sheer number of valves, sensors, and control systems shipped, was actually slightly negative.
Okay, so think of their business model like a heavily trafficked, privately owned toll bridge.
Right? Okay, I like that.
The bridge authority didn't see an increase in daily commuters this quarter. The volume of cars stayed the exact same as last year, but the operators realized their underlying costs were relatively fixed, so they just raised the toll by 10%.
And commuters have no alternative route across the river, so they just pay the higher toll.
Exactly. Every single extra dollar from that price hike drops straight to the bottom line. It expands their margins without requiring a single new car on the road. It's like a bakery selling the same number of cupcakes, but figuring out how to buy flour cheaper while raising the price of the cupcake.
That's spot on. And when you provide mission-critical industrial software and safety systems, you effectively own that toll bridge.
Right.
I mean, if you are operating a multi-billion-dollar semiconductor fabrication plant or, a highly volatile chemical refinery...
You're not cutting corners.
Exactly. You do not shop around for a discount generic brand for your safety valves or your distributed control systems. You pay Emerson's premium because the cost of a system failure is literally catastrophic. You're paying for risk mitigation just as much as you are paying for the hardware itself.
And that pricing power is what allows them to absorb macroeconomic inflation and still expand their margins. But they also cited corporate synergies as the second lever they pulled, right?
Yeah, they did. Emerson has spent, basically the last half decade shedding legacy lower margin businesses.
Like selling off their climate technologies division.
Right. And then acquiring high margin software centric companies like Aspen Tech and National Instruments.
So integrating those acquisitions is where the synergy comes into play. And I know synergy is often treated as like hollow corporate speak, but in this context,
it translates to hard dollar savings. When you bolt a company like National Instruments onto the Emerson chassis, you eliminate redundant administrative overhead. You consolidate supply chains. You integrate the sales teams.
Right, trim the fat.
Exactly. And by aggressively realizing the cost synergies from that National Instruments deal, they actually expanded their EBITDA margin by 40 basis points year over year. And that's assuming you exclude a specific software accounting drag that we'll dissect later.
Yeah, we will definitely get to that software dynamic because that was fascinating. But the macro takeaway from the top and bottom lines here is just high quality resilience. Volume was muted, but profitability was pristine.
Very pristine.
But, the aggregate numbers hide a really wild divergence taking place under the hood. When you dig into the regional and sector data in this transcript, you see a completely bifurcated global economy.
It's a tale of two cities, really.
Totally. So let's start with the bulls. Overall, underlying orders for Emerson were up 9%, but North America orders surged by 18%.
And I have to pause there because an 18% order growth for a legacy industrial company in a single mature geographic region is incredibly rare.
Yeah, you don't usually see that in the industrials.
You simply do not see that kind of velocity without a structural shift in capital allocation. And what's fascinating here is the subsegment data reveals exactly what is happening.
Right, they highlighted the Ovation business.
Yes, management highlighted a business unit called Ovation. It's their premier distributed control system and software platform, used primarily in power generation and water treatment. Orders in that Ovation business surged by an unbelievable 74%.
Wait, 74%? That kind of explosive metric is what you expect from a hyper-growth Silicon Valley software startup, not a company founded in St. Louis in the 1890s to manufacture electric motors and fans.
I know.
How does a legacy business unit like Ovation suddenly print that kind of growth?
Well, it is the result of multiple secular megatrends colliding all at once, primarily fueled by massive shifts in U.S. industrial policy.
Like the current administration's incentives.
Exactly. Heavy incentives for grid modernization, nearshoring of critical manufacturing, and electrification. Emerson is effectively positioning its bucket directly under the waterfall of that capital deployment.
Love that visual.
But the most fascinating data point management provided to explain this 74% surge was a specific project win. Emerson was chosen to automate the power generation for a new 1.7 gigawatt artificial intelligence data center here in the United States.
Okay, wait. I want to stop and unpack the scale of that for our listeners because 1.7 gigawatts is a staggering amount of electricity.
It's massive.
We are not talking about throwing up a few solar panels on the roof of a server farm. A single gigawatt is roughly enough to power 750,000 standard American homes. So this one AI data center requires the continuous power output of a mid-sized city just to keep the server racks running and the liquid cooling systems from failing.
Yeah, you cannot simply plug a facility of that magnitude into the municipal grid.
Right. A sudden draw of 1.7 gigawatts would cause catastrophic voltage sags. It would likely black out the entire surrounding region.
They absolutely cannot rely on the public utility for that. The hyperscalers building these AI facilities are being forced to construct dedicated behind-the-meter power generation plants.
And behind-the-meter meaning?
Meaning the power plant is physically located on the data center campus and bypasses the traditional utility grid entirely. These are highly complex microgrids, often utilizing, combined cycle gas turbines, massive battery energy storage systems, and advanced power routing.
And this is where the narrative around AI investment completely shifts. Because everyone focuses on the chip makers, right? The companies designing the neural processing units or the foundries etching the silicon.
NVIDIA, TSMC.
Exactly. We tend to view Emerson as a company that makes pipeline monitors and factory automation gear. But this 1.7 gigawatt contract proves that Emerson is actually a primary infrastructure play for the artificial intelligence boom.
They are providing the ultimate picks and shovels for the AI gold rush.
Yeah.
I mean, running a dedicated 1.7 gigawatt microgrid requires sub-second monitoring of turbine vibration, thermal output, frequency regulation.
All the stuff that keeps it from exploding.
Right. And that is exactly what the Ovation software platform does. Emerson won this contract to provide the power generation management system, executing it alongside a strategic collaboration with Prevalon Energy, who integrates the advanced battery storage into the mix.
Because if Emerson's control systems fail, the power trips.
The cooling system shut down, and literally hundreds of millions of dollars worth of AI silicon melt.
Oh, wow. So the chip makers might be building the brains of the AI revolution, but Emerson is building the cardiovascular system that keeps the blood flowing to those brains.
That's a perfect way to look at it. And the AI connection wasn't limited to just power generation either. Their test and measurement business, which is essentially the newly acquired National Instruments, grew orders by 20% alone.
Yeah, and management spent considerable time highlighting a specific software product there called Nigel AI.
Right. And the evolution of the test and measurement division requires a little bit of historical context to fully appreciate. CEO Lal Karsanbhai actually touched on this milestone during the call.
The 50th anniversary, right?
Yes. 2026 marks the 50th anniversary of National Instruments. It was founded in 1976 by 3 engineers from the University of Texas, James Truchard, Jeff Kodosky, and Bill Nolan. They were working in a lab, and they were entirely frustrated by the inefficiency of manually reading oscilloscopes and recording data.
It was incredibly tedious.
Extremely. Yeah. So they realized that if they could create a common interface to connect physical test instruments directly to a computer, they could automate the entire process.
Which led to the invention of LabVIEW in 1986. And that fundamentally changed engineering, because LabVIEW uses a visual programming language. Instead of writing lines of text-based code, engineers literally draw wires between virtual instruments on a screen to dictate how a physical test should be run.
Yeah, it became the absolute industry standard for hardware-in-the-loop testing.
Right, so if an aerospace company wants to test how a new wing flap actuator responds to turbulence, they don't have to fly the plane. They hook the physical actuator up to a test rig running LabVIEW, and the software simulates the aerodynamic stress.
Exactly. And fast forward to today, Emerson has injected artificial intelligence directly into that foundational LabVIEW architecture. Earlier this year, their Nigel AI advisor won industry awards in Europe as an AI assistant. But on this earnings call, management announced a massive paradigm shift. Nigel AI is moving from an assistant to an author.
And the distinction between an assistant and an author is huge in the software world. It is the leap to agentic AI.
Yes, agentic AI.
Because an assistant acts like a highly sophisticated search engine, right? An engineer can query it to find a specific diagnostic protocol or troubleshoot a wiring error. But an agentic AI author actually executes the work autonomously.
Management was very explicit about the productivity unlock here. Nigel AI can now ingest the parameters of a complex physical design, say a new semiconductor wafer layout, and it automatically generates the test scripts, optimizes the validation workflows, and executes the simulations.
That's incredible. Processes that traditionally took a highly compensated test engineer hours or even days to code manually can now be completed by the agentic AI in minutes.
Right. And if you are managing a semiconductor fab, your biggest operational bottleneck is often the validation phase. You cannot mass produce a chip until it has been exhaustively tested against thousands of thermal and electrical variables.
So if Emerson's Nigel AI cuts your testing latency from days to minutes, it accelerates your time to market dramatically.
It's huge.
Yeah.
That isn't just a nice-to-have software upgrade. It is a competitive necessity. And that explains the 20% order growth in test and measurement.
And that strength wasn't isolated to the United States either. Test and measurement orders in India were up 22%. The Middle East and Africa saw 9% order growth across the board, driven largely by massive greenfield project activity.
Yeah, management specifically pointed to liquefied natural gas, or LNG. Emerson secured a major contract for Sempra Infrastructure's Port Arthur LNG Phase 2 project on the U.S. Gulf Coast.
Which is scaling up to add, 13 million tons per annum of export capacity?
Exactly.
And LNG infrastructure is incredibly capital intensive. Plus, it's heavily reliant on the exact hardware Emerson provides. Because you are taking natural gas, cooling it to negative 260 degrees Fahrenheit until it condenses into a liquid, and then pumping it into massive tankers. Handling cryogenic fluids at high pressure requires what they call severe service control valves.
And Emerson's Fisher Valve division absolutely dominates this space for a reason. In LNG processing, you deal with a phenomenon called cavitation.
Oh, right, cavitation.
Yeah. When fluid moves through a valve at high velocity, the pressure drops. That causes the liquid to briefly boil into vapor bubbles. And as the pressure recovers, those bubbles collapse with immense force. It literally blasts microscopic holes into the solid steel of the valve.
Wow, just tearing the metal apart.
Exactly. So Emerson's severe service valves use highly engineered internal trims to break up the flow and prevent cavitation, ensuring the plant doesn't have to shut down for emergency maintenance.
So Sempra is buying those specialized valves. alongside Emerson's Delta V distributed control systems to manage the entire Port Arthur facility.
Yep.
So looking at the bullish ledger, Emerson is perfectly positioned at the center of the Venn diagram of global infrastructure. They are automating the AI data center microgrids, accelerating semiconductor testing with agentic AI, and controlling the cryogenic flow of the global LNG trade.
Just a very strong hand.
But, a true deep dive requires us to invite the lens. We have to look at the bearish drivers to present the full picture for you listening. Because the call wasn't perfectly flawless, the performance in other regions was actively dragging the company down.
Yep, we have to look at that. The geographic and sector weakness is highly concentrated. While North America surged, orders in Europe declined in the low single digits. And more concerningly, orders in China fell in the high single digits.
Which is wild, because that's a stark reversal from the last decade, where China was the undisputed high-velocity growth engine for nearly every global industrial manufacturer.
Absolutely.
So a high single-digit contraction in China is a massive red flag.
No.
What is the fundamental mechanism driving that deterioration?
Management was pretty transparent that the pain is deeply rooted in the chemical and automotive sectors. Let's look at Europe first. In Europe, the chemical industry is facing what is essentially an existential crisis.
Because of energy, right?
Yes. For decades, the European chemical complex, particularly giants like BASF in Germany, relied on cheap, abundant natural gas piped in from Russia to feed their facilities.
And that energy bridge has been effectively severed.
Completely severed. Energy costs in the region have spiked, rendering many legacy European chemical plants uncompetitive on the global market. They are idling capacity, and, when plants are idled, they simply do not buy new automation software or upgrade their control valves.
That makes sense. And what about China? The dynamic there is somewhat related, but structurally different, right?
Right. China went through a massive period of overbuilding chemical capacity over the last 5 years. They basically flooded their own market. Now they're dealing with domestic deflationary pressures and sluggish consumer demand.
So the chemical sector there has just hit a brick wall in terms of new capital expenditures.
Exactly. Management actually admitted on the call that they are capitulating on their China outlook. They lowered their projection to a low single-digit decline for the full year.
Though they did mention a few isolated pockets of strength in China, right?
They did. They're seeing demand for test and measurement. And ironically, they are seeing similar trends in power generation as the U.S.-China is building out massive AI infrastructure as well. And they are actively ordering Emerson equipment for nuclear and coal-fired power plants to feed that tech demand.
But the sheer weight of the chemical and automotive slump in China is just overwhelming those green shoots.
Unfortunately, yes.
Okay, so beyond the geographic weakness, I notice a specific margin metric in the intelligent devices segment that warrants scrutiny. Their sensor business saw margins contract by roughly 2 full percentage points year over year.
Yeah, that caught a lot of people's attention.
Because in a quarter defined by pricing power and synergy, a 2-point margin compression really stands out. Did they lose their pricing leverage on sensors?
They did not lose pricing power. CFO Mike Bachman addressed this directly during the Q&A. He attributed the compression to a combination of foreign exchange headwinds and geographic mix.
Okay, so the foreign exchange element is pretty straightforward mathematics.
Very straightforward.
Last year, the U.S. dollar's position against a basket of foreign currencies created a localized benefit for that segment when international revenues were converted back to dollars. That benefit simply didn't repeat this year, accounting for about half of the margin decline.
Right. The currency translation is just a structural reality of operating a multinational conglomerate.
Yeah.
You can hedge against it, but you can't entirely eliminate the friction.
Right. But what is the mechanism behind the geographic mix issue causing the other half of that margin decline?
It really comes down to the profitability profile of what they sell in different regions. So last year, the sensor division enjoyed a high concentration of premium software-attached sales in North America.
High margin stuff.
Exactly. This quarter, a larger percentage of their sensor volume actually shipped to Europe. And as we established, the European market is economically depressed.
Ah, okay.
So the business they did secure there was largely heavy project-based hardware installations, rather than the high-margin recurring software.
Got it. So when you blend a higher volume of lower-margin European project work with a lower volume of high-margin U.S. work, the aggregate segment margin compresses.
It's a textbook mix issue.
Okay, that makes sense. I also want to look at the supply chain. Because over the last 4 years, industrial earnings calls have been just a relentless drumbeat of supply chain chaos and component inflation.
Oh, it's been brutal.
And an analyst on the call brought up a very specific constraint: DRAM, or dynamic random access memory chips. The AI boom has triggered a massive supercycle for memory chips, driving prices through the roof. If Emerson is heavily pivoting into digital automation and test equipment, aren't they competing with NVIDIA and the hyperscalers for the same scarce memory supply?
That was a great question by the analyst. Chief Operating Officer Ram Krishnan took that one, and he clarified a crucial distinction in hardware architecture.
For what did he say?
He confirmed that Emerson buys about $8 million worth of DRAM annually, primarily to build out their control systems and testing hardware. But they are essentially shopping in a completely different aisle of the silicon supermarket than the AI developers.
What's the architectural difference?
Well, the hyperscalers and AI chip designers require the absolute bleeding edge of memory technology. Things like high bandwidth memory, 3HBM3, or Gen 5 DDR memory.
The really fast stuff.
Exactly. These chips prioritize extreme data transfer speeds necessary to train trillion-parameter large language models. That is where the massive inflation and supply bottlenecks are occurring.
Right, because Emerson's industrial systems do not need to train LLMs.
No, they need to monitor a safety valve in a cryogenic LNG plant for 20 years without failing.
So they prioritize reliability.
Exactly. Therefore, Emerson primarily buys older, highly stable generations of memory, like DDR3 and DDR4.
The industrial sector prioritizes reliability, thermal tolerance, and long life cycles over sheer speed. I mean, a DDR4 chip might be a decade old in terms of architectural design, but it has been exhaustively validated to run in a 120-degree factory environment without throwing a single memory error.
And Christian noted that while there is minor price inflation on older memory, it is entirely manageable within their pricing models. Their primary focus isn't cost, it's simply ensuring the supply chain lead times don't stretch out and delay their manufacturing timelines.
That makes total sense. And speaking of long-term planning, there was a really fascinating exchange during the Q&A regarding Venezuela.
Oh, that was so interesting.
Right. An analyst asked CEO Lal Karsanbhai for an update on their strategy in the country, which at first seems completely disconnected from a standard quarterly earnings discussion. But Karsanbhai revealed that Emerson has a massive dormant installed base of equipment in Venezuela worth approximately $1 billion.
$1 billion of hardware deployed in the country currently operating under heavy international sanctions.
Yeah, and most of that infrastructure is concentrated in the Orinoco Belt, dealing with heavy crude oil extraction and refining. Because of the geopolitical situation, Emerson has been legally restricted from actively servicing or upgrading that equipment for years.
They are limited to a minuscule amount of direct, legally permitted business, with Chevron totaling, I think, under $1 million annually.
But industrial hardware degrades. Valves corrode, sensors fail, and control software becomes obsolete. That billion-dollar installed base has been starved of maintenance.
And Karsanbhai stated that Emerson is actively monitoring the geopolitical landscape and Venezuelan national oil laws, basically preparing for the possibility of foreign investment reopening.
But the challenge isn't just shipping them replacement parts. I mean, if sanctions lift tomorrow, you can't just drop a crate of Fisher valves on the dock in Caracas and expect the oil flow to resume. Karsanbhai highlighted a severe brain drain. Venezuela has lost a massive percentage of its technical and engineering talent over the last 2 decades.
And that is where Emerson's modern software pivot becomes a massive strategic advantage. You cannot physically find enough local engineers to manually turn wrenches and calibrate sensors across the Orinoco Belt.
So what do they do?
If that market opens, Emerson will deploy systems like Delta V remote operations and agentic AI diagnostics. They will sell the digital architecture required to run those plants remotely, basically compensating for the lack of on-the-ground human capital.
Karsanbhai actually compared their readiness to Emerson's rapid mobilization in Iraq after the Gulf War. It is a brilliant example of how industrial conglomerates must operate on decade-long geopolitical time horizons, not just quarter-to-quarter financial cycles.
It is a dormant billion-dollar call option sitting right on their balance sheet.
Truly. Okay, let's transition our focus from the geopolitical horizon to the immediate financial windshield. Management provided highly detailed guidance for the remainder of 2026. What are the core metrics Wall Street is modeling?
So the guidance demonstrates deep confidence in their backlog and the momentum in the North American power sector. For the full year 2026, management raised both the bottom and the midpoint of their adjusted EPS expectations.
What's the new number?
They are now guiding for earnings per share between $6.40 and $6.55.
And raising the EPS guide in Q1 is a definitive signal to the market. It indicates the margin expansion we saw isn't a one-off accounting fluke. It is a sustainable operational baseline.
Absolutely. But the top-line sales guidance is where the narrative gets incredibly dense.
Yeah, it does.
They reiterated their expectation for roughly 4% full-year growth, but they added a massive caveat. If you exclude a headwind they call the software contract renewal dynamic, their underlying growth expectation is actually 5%.
So if we connect this to the bigger picture, this specific dynamic is probably the most critical concept for investors to understand in this transcript.
Oh, without a doubt.
Because it is a textbook example of GAAP accounting rules creating a temporary illusion of weakness. Throughout the call, management referenced this software contract renewal dynamic, dragging down Q1 sales by a full percentage point, depressing EBITDA margins by 70 basis points, and projecting it to act as a $65 million headwind in Q2.
Yeah. And if I am a retail investor skimming the headlines, and I see Emerson warning that Q2 revenue will be depressed by $65 million, my immediate reaction is that they are losing customers or slashing prices.
Right, you'd panic. So we need to dissect the actual mechanism of this accounting rule. How does renewing a software contract actually result in lower recognized revenue?
Okay, to understand this, we have to look at the ASC 606 revenue recognition standard, specifically how it applies to different types of software licenses. Historically, when Emerson sold a major software package, it was often structured as a term license with a maintenance agreement.
Okay.
Under GAAP accounting, the company must estimate the total value of the software license itself and recognize that massive chunk of revenue entirely upfront on the day the contract is signed.
All at once.
Exactly. And then the smaller ongoing maintenance portion is recognized ratably over the 3 or 5 year term.
So in year one, Emerson gets a massive revenue spike on the income statement. But what happens in year 4 when that contract expires and the customer wants to renew? The customer already has the core software architecture installed.
Precisely. When the customer renews, they are essentially just renewing the maintenance, the ongoing support, and perhaps transitioning to a true software as a service or SaaS cloud model.
Okay. And under SaaS?
Under a SaaS model, you do not recognize a massive lump sum upfront. You recognize the revenue in steady, equal monthly increments over the life of the new contract.
Wow. Okay, so the cash flow from the customer hasn't fundamentally changed. The customer is still paying Emerson millions of dollars a year, but the accounting department is forced to report lower revenue in the current quarter because they aren't allowed to book that massive upfront lump sum anymore.
Exactly. The revenue is being spread out horizontally instead of stacked vertically on day one.
So it creates what the software industry calls a valley of death in the income statement during a transition period.
Yes, that's exactly what it is. Emerson has aggressively acquired software companies like AspenTech. A massive cohort of those legacy term licenses is coming up for renewal right now.
So the customers are renewing, the business is healthy?
Very healthy. But the accounting transition creates an artificial $65 million crater in the Q2 projections.
So management is explicitly telling Wall Street, do not judge the health of our software business by the GAAP revenue line right now. Look at the ACV.
Annual contract value, or ACV. This is the metric that strips away the noise of revenue recognition timing. ACV represents the annualized forward-looking value of all active software subscriptions.
And what did they say about the ACV?
Management reported that the ACV of their software portfolio grew 9% year over year, hitting $1.6 billion.
Okay.
Furthermore, they expect that ACV to grow by more than 10% for the full year 2026.
That is the real number right there. A 10% growth in annual contract value proves the fundamental demand is expanding. Customers are committing more capital to Emerson's software ecosystem.
Yeah, the Q2 revenue headwind is purely an administrative mirage. Management noted this dynamic is primarily a first-half phenomenon. And as they lap these tough comparisons in the second half of the year, the overall growth rate will re-accelerate towards 6%.
And despite the accounting headwinds depressing the top line, the sheer cash generation of the underlying business remains largely unimpacted. Management used this call to reiterate a highly aggressive capital return strategy. They are committed to returning approximately $2.2 billion directly to shareholders this year.
That's a lot of cash.
Right. It's structured as $1.2 billion in dividend distributions and $1 billion allocated to share repurchases.
And they aren't just making empty promises on buybacks either. They executed $250 million in share repurchases in Q1 alone.
But the true North Star for Emerson isn't just the 2026 capital return. It's the 2028 operational targets Karsanbhai laid out. They are aiming to transform this company to achieve $21 billion in top-line revenue, $8 of adjusted EPS, a 20% free cash flow margin, and most importantly, 40% incremental margins.
That incremental margin target is the holy grail.
Explain why that's so important for our listeners.
Well, incremental margin measures how much of every new dollar of revenue falls directly to the operating profit line. Historically, if an industrial company sold a new steel valve, maybe 15 cents of that dollar became profit.
Because you had to buy raw steel, pay factory labor, cover shipping.
Exactly. But if you sell a new digital license for Ovation software, the cost of goods sold is virtually zero. 40 cents of that new dollar becomes pure profit.
That's incredible leverage.
It is. The entire divestiture of Climate Technologies and the acquisition of National Instruments was engineered to drag Emerson's incremental margins up to that 40% software standard.
All right, we have torn this earnings call down to the studs. We've mapped the pricing power paradox, analyzed the staggering 1.7 gigawatt AI data center requirements, decoded the ASC 606 software accounting matrix, and weighed the macroeconomic collapse of the European chemical sector.
We covered a lot of ground.
We did. It is time to deliver the bottom line. Looking at the totality of this data, what is your fundamental verdict on Emerson Electric?
My verdict is unequivocally bullish. The bearish elements, the stagnation in Europe and the real estate-driven chemical slump in China, are cyclical macroeconomic realities. They act as a drag, sure, but they do not break the core thesis.
So what pushes them forward?
The bullish drivers pushing Emerson forward are structural, multi-decade secular shifts. You have to look at the backlog to see the future.
Right, because the backlog is the definitive leading indicator for any industrial operation.
Exactly. Emerson's backlog currently sits at $7.9 billion. It's expanding 9% year over year. Even more critically, their book-to-bill ratio remains at a highly elevated 1.13.
And for anyone unfamiliar, the book-to-bill ratio basically compares the value of new orders coming in to the value of products being billed and shipped out.
Right. So a ratio of 1.0 means you are replacing inventory exactly as fast as you sell it. A ratio of 1.13 means that for every dollar of product Emerson managed to manufacture and ship this quarter, they took in $1.13 in new legally binding orders.
So they are accumulating future revenue significantly faster than their factories can fulfill it.
They are essentially stacking a massive fortress of deferred cash flow. And when you analyze the composition of that $7.9 billion backlog microgrids for hyperscale data centers, agentic AI testing for semiconductor fabs, and severe service valves for LNG export terminals, you realize these are not discretionary capital expenditures.
No, these are the mandatory foundational pillars of the next iteration of the global economy.
The macroeconomic focus has shifted fundamentally toward energy security, supply chain sovereignty, and the physical compute limitations of artificial intelligence. Emerson is positioned precisely at the choke points of all three trends.
So what does this all mean for you listening at home? If you are analyzing this transcript to manage your own portfolio, here is the actionable framework. Do not let the Q2 headlines shake you out of a position.
Yeah, you can't panic.
Wall Street's algorithmic trading models are highly reactive. If Q2 prints a mere 1 or 2% gap revenue growth, the algorithms may trigger a sell-off. Completely blind to the fact that the ASC 606 software renewal dynamic is artificially depressing the top line.
You must look past the accounting valley of death and focus on the 10% ACV growth.
Exactly. You do not hold Emerson for a short-term Q2 revenue beat. You hold this equity because they are systematically locking down the critical infrastructure of the U.S. power grid, and you are waiting for those 40% incremental margins to fully materialize by 2028.
That is the correct analytical posture. The ability to expand earnings by 6% on flat physical volume demonstrates the sheer operational leverage management has built into this newly restructured entity.
It's impressive.
When the global macro cycle inevitably turns, when interest rates normalize, and the European and Chinese industrial bases begin to restock inventory, Emerson's profit expansion will be exponential, not linear.
I want to leave you with one final provocative thought to pull on before you allocate your capital. The financial media is entirely consumed by the artificial intelligence narrative. Hundreds of billions of dollars are flowing into the sector.
Oh, it's all anyone talks about.
But the vast majority of retail focus is locked entirely on the companies designing the silicon chips and training the large language models. But this earnings call revealed a stark physical reality. A single modern AI data center requires 1.7 gigawatts of dedicated behind-the-meter power just to turn the servers on and prevent the cooling systems from failing.
It literally requires the electrical output of a mid-sized city operating with zero tolerance for frequency degradation. And it is entirely orchestrated by Emerson's software.
Exactly. The processing power of AI is no longer constrained merely by the density of the silicon. It is constrained by the physical limits of power generation and thermal dynamics. As energy becomes the ultimate bottleneck to artificial intelligence, the companies that control the microgrids, the switchgear, and the cooling valves hold massive leverage.
They absolutely do.
While the entire market is fighting over who owns the recipe for the AI software, Emerson Electric is quietly building the only automated power plant in town. Our legacy industrial conglomerate's the ultimate overlooked backdoor investments of the AI revolution. It is something for you to thoroughly mull over before you make your next trade. Thank you for joining us on this deep dive into Emerson Electric. Keep questioning the consensus and keep digging into the data.